2022 and 2023, particularly 2022, there were big layoffs, especially in tech. We saw kind of the tech stocks roll off in 2022 and company growth stalled. We spoke about Google. I think they didn't grow too much in 2022. So a lot of companies were laying off a lot of workers. Some of the big ones, Ernst & Young, a big accounting firm, cut 3,000 jobs. Spotify cut 17% of its workforce, 1,500 jobs. T-Mobile cut 7% of its workforce, 5,000 jobs. Amazon cut 9,000 jobs, although Amazon, I think, employs over a million people or something insane like that, so very small percentage. Meta cut 10,000 jobs, and as you just said, Alphabet cut 12,000. So going into 2024, despite some of those, obviously some of those numbers, they seem pretty astounding, 10,000, 5,000. Despite all of that, US unemployment at the end of the year was still at basically a record low. It was at 3.7%. I think the record low is maybe 3.4% or something like that. But regardless, anything in the 3% or even the 4% range is insanely low. The labor market has continued to be extremely tight. So even though some companies have been laying off, broadly speaking, or at least on average, I don't know, these numbers are kind of flawed in some ways because they're just looking at broad averages, but generally speaking, the labor market has been incredibly favorable for workers, and that's why there's also been a lot of wage growth and that sort of thing.
It's kind of mind blowing, really.
It is
how low unemployment has been. Yeah,
especially given
it's very unexpected.
Yeah, right. Rates go up considerably. So you expect businesses to have higher expenses. Consumers have less money, so you would think they'd be spending a little bit less, and all of that you would think would culminate in a lot more layoffs and that sort of thing. But it hasn't really happened. However, hiring has kind of slowed in recent months. And employees, this is a report from the Wall Street Journal, I think, employees are quitting at a lower rate than pre-pandemic. So they were kind of seeing that maybe the market is, loosening a little bit, becoming a little less tight. And with that said, there was quite a few layoff announcements this year already so far. So as you said, Alphabet announced that they'll be laying off, I think they said several hundred employees, shifting their focus towards investment in AI. So just kind of reallocating resources from areas where they think they don't need as many employees to focus in on artificial intelligence. Bank of New York Mellon to cut 1,500 jobs, 3% of its workforce. BlackRock will cut 3% of its workforce, which is 500 people. Coinbase and Crypto.com cutting 20% each of their workforce. Microsoft was an interesting one there to cut 10,000 employees, but represents less than 5% of its staff. PayPal cutting 2,000 jobs. Yeah, so some of these companies, you can't even comprehend how many people they hire. Like Walmart and Amazon, I think both of them hire more than 1 million people.
Unbelievable.
Which is just like 1 million people. Like, that's crazy. Like, like what's their payroll like? It's insane.
Yeah. It's kind of crazy saying laying off, BlackRock's laying off 500 people, and then Microsoft is laying off less than 5% of its staff, but that's 10,000 employees.
Insane.
Yeah, unbelievable. Anyway, sorry.
Yeah, PayPal 2,000, 7% of their workforce. Here's a crazy one. Salesforce to cut 10% of its staff, 80,000 people.
Whoa.
Which is, I think that's the biggest number in the list there. So the biggest number of people.
That's huge.
And not the biggest percentage of staff, but yeah, 80,000 is crazy.
That's huge.
To even like
80,000.
Like that's got to be it.
I didn't realize Salesforce had that many employees.
Yeah, it's crazy, right? It's insane.
Yeah.
And to be fair, in Salesforce's case, they're talking, not in the US. This is their global workforce. So
surely.
That kind of plays a role. So why are these layoffs happening? Well, it kind of varies, I think, a little bit industry to industry. So in tech, for example, lots of companies are investing very heavily in AI. So as Alphabet actually said directly, a lot of companies are just reallocating resources. So whether that's laying off people in other areas and then hiring in new areas that are related to AI, or just laying off people and then allocating that cash flow to assets that they need to buy in those areas. In the financial sector, why are layoffs happening? Steve Eisman, he did an interview where he kind of spoke about this pretty clearly. He kind of sees it as three factors that are hurting their ability to grow: higher interest rates, lower deposits, and stricter capital requirements. So what does that mean? Higher interest rates means paying out more interest to depositors, of course. So your savings accounts have higher rates. Of course, higher rates also does mean they can sell mortgages at higher rates. But banks, since COVID, have a lot of fixed assets on their books that have really low interest rates. So even though they can now, of course, sell mortgages at a higher rate, they are kind of stuck with, a lot of the banks are stuck with enormous amounts of, say, 10-year government bonds that they bought in 2020 at less than 1%. So they've got all these assets earning absolutely nothing. And now they're having to pay out more to depositors because of the higher interest rates. The second factor was deposits at US banks have been declining for well over a year now, which of course means that they have less of an ability to lend out. And capital requirements got quite a bit stricter after the banking crisis that happened just last year. So those are kind of the reasons why the financial sector is kind of looking to cut costs. And then just broadly, I think it's, we've spoken about it a lot. Of course, higher rates mean higher cost of debt for businesses. And what we're probably going to start seeing this year, and especially over the next 3 to 5 years, is a lot of companies refinancing their low interest debt into higher debt. Companies often have 3, 5, 7, 10, 12-year fixed periods on their debt. So a lot of companies have really low interest rate debt at the moment that will roll over at some point into a few percentage points higher. And, as that happens, companies can obviously see that coming. So that obviously plays a role as well in wanting to cut costs now to prepare for that.
Yeah, this kind of stuff makes me think like there's so many people that rejoice like, what are you talking about? There's no recession. There's no economic problems. Nothing's going wrong. You always get like those people where you make a really well kind of reasoned video on YouTube, and you kind of like, yeah, well, these are some of the, you're not doomsday predicting, saying, sky's gonna fall. You're saying, look, these are some reasons why things might be a little bit tougher this year, and you get people in the comments saying, oh, you're wrong, and blah blah blah. But I think that this is kind of showing that that maybe we haven't quite felt the full impact of all of this kind of all the macroeconomic changes just yet. Yeah. I mean, everybody's kind of rejoicing that, we got through and there's been no recession, and now the Fed's going to cut interest rates and we're through. But I just look at stuff like this and I'm like, yeah, really? Like, are we really through?
Yeah, I mean, it's obviously impossible to know, what's going to happen. But these are real risk factors. They're just kind of things that are there, right? It's not, yeah, I agree. You're right. A lot of people say, well, the rate hikes have stopped, so we're good. But it's like, well, maybe rates are already at an unsustainable level for a lot of businesses when the debt rolls into a high interest rate. It's just that they haven't had to refinance yet, right? Like, or maybe, some households are negative cash flow, but they haven't run out of savings yet. So like, there's not to say something, to shout doom and gloom and say something is happening, but these are, real things that are there, and they're just risk factors, and we never know how it's going to play out. Maybe it works out all right, and or maybe it doesn't. So yeah.
I hope it works out all right.
Yeah, and long term,
I don't know. Maybe I'm too bearish. Long term, I'm confident it will all work out okay. And if not, then we're all dead. So who cares?
Nice, great way to end the podcast.
All right,
and
on that cheery note,